Okay, we're going to go ahead and get started. The flow of incoming folks is slowing down just a little bit, so we are going to get started. I'm going to go through some housekeeping in just a minute so that you kind of know how we'll do the run of show, but welcome. You're here for your Mizzou financial roadmap. So what we're going to be talking about tonight are some information that's going to help you both plan for this year, plan for this first bill coming up in September, and then onward. How are we going to decrease our costs? How are we going to identify new resources, apply for scholarships, and the like? So my name is Alex. I'm the interim manager at the Office for Financial Success here on campus. I'll tell you a little bit more about what the OFS is in just a moment. Just so you know, joining me today are a couple of members of our student financial aid team, and so they are going to be answering questions in the chat as I present. We have a lot of information to cover tonight, so just a couple of things to alleviate maybe some concerns about missing something. We will be recording the presentation and we're going to be sending it to those of you registered, so everyone here. We are also going to be using the Q&A tonight. Like I said, our student financial aid friends are in the chat. So please, as much as you can, keep those questions fairly general. If you have some clarifying questions about the content of the presentation, feel free to ask those, but please keep specific questions about your financial aid situation. Not tonight. So if you want, you can reach out to Student Financial Aid or my office, the Office for Financial Success, if you have more personal questions that you'd like answered. So before we begin, I think it's really important to understand and ground us in some of the resources that are available to you, students, if you're on the call, and parents, of course, to you. So we actually have 3 financial offices on this campus, and a lot of campuses just have 2. The first 2 I'll talk about. So I'm going to share a little bit more about what my office does because it's a little less common in this space. So the first office that we have is our Office of Cashiers. And cashiers is going to be where you're going to go if you have any questions related to your billing or charges. So if you have questions about getting set up as an authorized user on our TouchNet billing system, the cashier's office can assist you. Student financial aid is our office who administers financial aid. So they are the ones that are receiving those FAFSA applications, receiving those external scholarships, and ensuring that all of the aid that you're eligible for gets applied to your account. Now, if you have any questions about your eligibility for aid, or if you have had changes in your you'll want to reach out to Student Financial Aid because they can answer questions for you and, potentially look at your current circumstances and see if it's appropriate to adjust that aid package since the FAFSA was several years ago. And then finally, my office is the Office for Financial Success. So I'm going to share a little bit more about that in just a moment and what we do. But in general, we are here to assist you to kind of put the puzzle pieces together. So we have our charges, we have our financial aid, and our office can assist you to help you make a plan. I've got a few honorable mentions because student finances are not just paying the bill. So a couple of honorable mentions about resources that are available for you and students you on the call is our Career Center. They can assist with things like resume development, finding part-time jobs, or finding work-study positions. Our care team supports students by helping connect them to resources like SNAP benefits or Medicaid applications. And our TRIO student support services, they are kind of a well-rounded support resource for students that are first generation in their families to attend college, low income, or have disabilities. And then Tiger Pantry is our on-campus food pantry, and any student can access that. They can register as a household, and it just helps to kind of lower those food costs. So what is the OFS? We are a free financial education resource that students can use to build their financial literacy, increase their financial capability, and generally our goal is that we're improving financial well-being. And we do that in a variety of ways. So the first way that we support students and families is through one-on-one financial coaching. And we will talk about not just paying for college topics, but anything from building credit, loan repayment, assessing our spending and building budgets, to even how can I save and when am I ready to invest. We also have free online guides and tools. So these are all on our website, financialsuccess.missouri.edu, and we are building out those tools all the time. And then we host group workshops. So we have just about weekly workshops, and these are going to be opportunities for students to come and learn generally, how do I build a budget? How do I build my credit score? How do I know when I'm ready to save and invest? So enough about us. We're going to get to what you actually came here for. So our goals for today, we're going to spend the first part of this webinar talking about planning for this year. So we're going to answer the question, how do I know what my bill is going to be? How do I make student loan decisions? And then what's the timeline of what's coming up next? In the second part of the presentation, we're going to be getting into more strategies for long-term planning, why we need to be planning across the full potentially 1 to 4 years, depending on if we have transfer students in the audience or not, so that we can borrow strategically and reduce costs over time. So we'll get started with planning for this year. And I'm going to use this framework for helping us walk through how we're going to be planning. So the first thing that we're going to do is understand costs. Then we're going to look at all of our non-loan resources because we really want to maximize those. That's going to help us to see what our funding gap is going to be. And then from there, I'm going to share quite a bit about different student loan types so that you can borrow as intentionally and strategically as possible. So in order to understand costs, one of the most important terms to understand is this term cost of attendance. And there's a lot of confusion and misconceptions about what the cost of attendance is. It is the number that you saw whenever you opened your financial aid offer notification. And it's also available for students to see in their Mizzou financial aid portal. So what this shows is estimates of both direct costs. So these are the costs that are billed by Mizzou to you. This includes tuition as well as on-campus housing and meals if that's applicable. And it also includes indirect costs. So indirect costs are things that may not be billed by Mizzou. So for example, if you live off campus, we're still going to estimate and allow you to use financial aid for those costs. So that's built into this term, cost of attendance. Now, what's kind of confusing to people is that they presume that this is their exact cost, but really what it is an estimate. It's an estimated cost of attending Mizzou for 1 year. So you'll receive a new cost of attendance estimate every single year. It is not your bill, and it's not an exact estimate of your personal costs. So right now, if you look at your cost of attendance estimate, the number that's going to be most accurate right now is going to be those tuition costs because that's tied to the major that the student has declared. So if it's not our bill and it's not our exact cost, why does it matter? Well, it matters because the cost of attendance determines the maximum amount of financial aid that you're eligible to receive. So that financial aid includes all of the things that you see on the screen here. It includes our grants, our scholarships, so the gift aid that we don't have to pay back. It includes our educational loans, and it also includes work study. So across those different sources of funding, we can't exceed the number that you see on your cost of attendance estimate. So the next question I always get from families is, okay, well, if the cost of attendance isn't what we're going to pay, how do we know what we're going to pay? So the way that you know what you're going to pay is, one, our charges are going to post on July 23rd. So you could wait until July 23rd, log into TouchNet, and you can see those costs. If you would like to see them before bills post late during the summer each year, you can actually go to the cashier's office website. And we've included a link here. It's cashiers.missouri.edu. And there's a tool that students can use to, they look up their major and it tells them exactly what those tuition and fees are going to cost. So this is actually online right now. All of our rates for housing and dining are also online. So if you want to get a little bit of a head start, you could go to those websites today. And then those indirect costs, those are a little bit more unknown for incoming students. But generally, we would estimate that your books and supplies may cost $300 to $500 per semester. And then miscellaneous and personal expenses are things like disability support resources, for example, or gas to and from campus. So what we want to do first is estimate our personal costs. Every spring and summer, we want to estimate those personal costs, and that allows us a starting point for figuring out what our funding gap is going to be. From there, we're going to assess our non-loan resources, and I like to break these up into two different categories, our current resources and our future resources. So current resources are those that are available at kind of in a lump sum at the beginning of the semester. They're going to pay to our bill before our installment plan is created. So these are things like your gift aid, your scholarships and grants, as well as lump sum cash available from savings or maybe 529 educational plans, things like that. Then we assess our future resources, and this is where it takes a little bit more planning for families. So having a discussion about what amount of monthly income is available to pay towards that installment payment. And what you can do is once we kind of determine what that monthly amount is, we're going to multiply that by 4 because there are 4 installment payments during the year. And we're going to be able to subtract that from our expected costs. So we have talked about identifying your personal costs. We're going to be assessing our current resources, so things like our gift aid and any lump sum cash we have available. And then we're going to subtract those future resources, our available monthly income. And if we want to look at the annual picture, we're going to multiply that available monthly income by 8 because there are 8 installment payments across the full year. So after we do that, we get our annual funding gap. And most often, this is going to be our student loan needs. Now, of course, there are some levers that you can pull if we can increase income in some ways, but this is a good starting point. So what we're going to talk about next are the different types of loans and how we can really borrow intentionally. So I want to acknowledge before I get started that student loans are a topic that can bring about a little bit of stress. I'm hoping that I can alleviate some of that just by giving you a bit more information so you can make informed decisions. So we know that those student loans are here to help us reach our educational goals. They help bridge funding gaps so we're not having to work full time while we're enrolled in school, and they let us spread those costs over time. But because of the inherent nature of loans requiring repayment, we also need to be really thoughtful about those because if we overborrow, we are impacting our future financial flexibility. So I'm going to give you some information a little bit later about how we can kind of assess what those borrowing thresholds are. But first, I want you to understand what loan sources you have available to you. So the first source of loans is going to be those federal loans. These are the ones that you access through filing your FAFSA each year. And there are 3 different types. I'm going to go through these in a little more detail in just a moment. But besides those federal loans, we also have private student loans. So private student loans are those, and I apologize, something's happening with my slide that it's got duplicate words, so ignore that. But those private loans are ones that come from banks and from credit unions. So between those loan sources right now, we're seeing interest rates that are as low as 2.39% all the way up to about 17.99%. Our federal loans tend to be on the low to mid side of that range. So our federal student loans right now for 26 and 27 are going to be at 6.52%, and the Parent Plus loans are currently going to be 9.07%. And then those private loans are across that spectrum. Now, I'm on a lot of like Reddit threads and Facebook groups where parents are sharing a lot of the information about the loans that they're receiving. And what I'm seeing is that borrowers with strong credit are currently kind of being offered loans in the rates of around 6 to 10%. Some borrowers are being offered sub 6% loans, but it is few and far between. So I know that a lot of lenders are promoting those really low rates, but wanted to kind of give you a realistic idea about where a lot of borrowers are landing. Now, one of the most important things to understand with student loans is that there are distinctions in the repayment flexibility and the hardship protections that they have. So going into the borrowing process, understanding the differences between these is really important. With private loans, there is typically limited borrower protections, though some private lenders do have borrower protections like death and permanent disability discharge and deferment and forbearance. So deferment and forbearance is the ability to pause payments for specific circumstances. Parent Plus loans have a little bit more protections than those private loans generally, and so Parent Plus loans have death and permanent disability discharge, deferment and forbearance possibilities, as well as dispute and complaint resources through the Federal Student Aid Ombudsman's Office. And then federal student loans tend to have the highest protection. So these include everything that I have just mentioned, in addition to flexible repayment plans and the ability to change repayment plans as circumstances change in life. There's also 3 loan forgiveness programs for federal student loans. So we're going to talk about each of those 3 types of loans. I'm going to start with federal student loans. So for federal student loans, the borrower is the student. There's no cosigner, there's no parent on that loan. For first-year students, that limit is $5,500. It's split between the 2 semesters, and each year that limit increases until year 3. It gets up to $7,500 for years 3 and 4. Students that are independent do have a higher limit than what I have here. So it's about $4,000 more in those first 2 years and $5,000 more in the 3rd year. Important to understand that tax dependency and FAFSA dependency are 2 very different things. So a student could be tax dependent, could be financially independent, and they still need to include their parents' information on the FAFSA. The APR for federal student loans is fixed at 6.52% for this year. That's set annually, so the rate for 2027, 2028 may be lower and it may be higher. And then federal student loans have about a 1% origination fee. So it's about a $10 fee per $1,000 borrowed. Now, there are some advantages to federal student loans. The first is that no credit history is required and no cosigner is required. So this is helpful for our incoming students that maybe haven't had the opportunity to build credit. There are no required payments while students are enrolled at least half time, and there's a 6-month grace period, meaning that they don't have to start repaying until 6 months after they graduate or drop below half-time status. There's also repayment flexibility. So with federal student loans, the student actually declares their loan repayment plan when they graduate after their grace period. And during their repayment period, they have flexibility to change those repayment plans as their needs change. And then currently there are 3 loan forgiveness programs available. There's a lot in the news about the potential for these loan forgiveness programs to go away. I don't think they will. So I think it's important to understand that those programs are still available. So some things that are good to know about federal student loans. First, the subsidized loan is the one that I call the super loan. That's the loan that no interest accrues through the grace period. This is the only need-based federal loan. So if you're eligible for the subsidized loan, you will see that on your financial aid package. But everybody is eligible for unsubsidized loans and then potentially the Parent Plus loan. So only the subsidized loan is need-based. Again, that annual limit increases over time by $1,000 through years 2 and 3. And then an additional $4,000 in year 1 is available for students that are independent or for students whose parent is denied a Parent Plus loan. And then again, that interest rate is valid for this academic year. So any loans taken in the fall, spring, or summer would have that 6.52% interest rate. So we're going to move on to Parent Plus loans. So for Parent Plus loans, the borrower is the parent. The student has no legal responsibility for that loan. Currently, the limit is $20,000 annually. This is a change. So if you have older students, this is a new limit that is a result of the OB3 bill. So it's $20,000 annually. And the APR for this year is 9.07%. The Parent Plus loan also has an origination fee of 4.22%. So it's slightly higher than that federal student loan. And that origination fee is kind of taken off the top before the loan pays out to the student's account. Now, there are some advantages to the Parent Plus loans. So the first advantage is that they are relatively accessible. So there are limited credit requirements, so individuals who may not be able to access private loans may be able to receive a Parent Plus loan. In addition to that, the interest rate is fixed and it's not influenced by a credit score. So again, it's 9.07% for any person that takes out a Parent Plus loan this year. The way repayment plans work for Parent Plus loans is it's based on the amount that's borrowed, and that repayment plan will be anywhere from 10 years to 25 years. Now, anybody can make extra payments. So if a person was assigned a 15-year term based on the amount that they borrowed, they can certainly make extra payments and pay that off early with no prepayment penalties. And then some additional benefits of the Federal Parent Plus loan is that there is death and disability discharge if either the student or the parent were to become permanently disabled, for example, the loan could be discharged. And there's also deferment and forbearance available. So again, that's payment pauses based on specific circumstances. So there are some eligibility requirements for those. Some things that are important to understand about the Federal Parent Plus loan is that there is a newly imposed $65,000 lifetime limit per child. So if you were to borrow $20,000 limit in the first 3 years, that senior year, the limit would be $5,000. If a parent applies and they are denied a Parent Plus loan, the student is eligible for that additional $4,000 of unsubsidized loans. So this is often a good option for families that may not be able to access private loans at this time because the student is able to access a lower cost loan. And again, that student has no legal responsibility for this loan. So one thing I want to suggest is that if there was going to be an informal arrangement between parent and student about the student repaying it, it's really important to understand that there could be inadvertently some negative long-term impacts to that. So for example, if the student was going to get a mortgage, the parent loan wouldn't be listed in their debt. And so they may be offered a mortgage that they won't be able to afford if they're also paying that Parent Plus loan. So just really important to be thoughtful and strategic about any kind of informal arrangements we have with these loans. So next I'm going to talk a bit more about private student loans. So private student loans are really variable. There are different kind of combinations of borrowers. So we could have the parent only, we could have the student only, or we could have the student and a cosigner. And that cosigner does not have to be the parent. The annual limit for these is going to be our cost of attendance, that's that estimate, minus all of our other financial aid. And then again, those interest rates vary from 2.39% on the low end to 17.99 on the high end. There's also both fixed or variable rates in the private loan market. I strongly recommend people look at the fixed rate loans because they're much easier to budget for. We know what our repayment's going to be when we take that loan out. I have seen students take variable rate loans that went from sub 4% all the way up to 14% by the time they graduated. So I just generally advise against those variable rates. So some advantages to private student loans. The first advantage is that there may be a higher borrowing limit than the Federal Parent Plus loan. The second advantage is that these generally have lower origination fees. So most private lenders right now have zero origination fees for these loans. And then the other advantage is there are multiple repayment structures that allow you to kind of pull some levers and influence that interest rate. So not a challenge, but one difference between federal loans and private loans is that you select these things when you apply for the loan versus when you go into repayment, which is how federal loans work. So with private loans, you are selecting when your repayment begins. That could be immediate, where we're paying our principal and interest, just like a car loan. It could be interest only, could be fixed payments. So for example, maybe you're paying $50 per month. Or we could defer both principal and interest until after the student graduates. The other lever that you can pull is how long repayment will last. So most private lenders, when you first apply, they're going to show you various options that kind of are these different levers. 10 years with interest only is going to be this percent. 10 years principal and interest immediately is this percent. And you'll kind of be able to see those differences when you apply. So some things that are good to know about private student loans. Now, generally, they are going to have higher interest rates and less repayment flexibility than those federal options. That's not always the case, but often it is the case. So it's usually advised to use federal student loans first, and then we kind of decide between those private or Parent Plus loans. Students are almost always going to require a cosigner during their first 2 years in college because they do not have the income or the credit history built up to be able to take out the loan on their own. However, private loans have a clause called a cosigner release. And it's really helpful for the cosigner because what it is after the student graduates and they start making on-time payments, they've built their credit up, they have a strong credit history, the cosigner can actually be removed from the loan. So I've seen anything from 12 months to 48 months for those cosigner release options. The other parts about private student loans are that there's generally limited financial hardship flexibility. So that is something I recommend that people proactively look for as they're looking for private loans. And there's also limited death and disability discharge. So again, something that I would recommend looking for as we're looking at the terms of the loans we're selecting. When we're looking at private loans, it's important not just to look at those interest rates because the features of the loans can make them more or less attractive than something like the Parent Plus loan, for example. So we want to be looking at, do we have flexible repayment timeline? Am I able to maybe make fixed interest payments of $50 per month and I can make that work while I'm in school? Are we looking at fixed or variable rates? So again, I recommend those fixed rate loans over the variable rates. Do we have a cosigner release option? What's the available grace period? With private loans, you'll see grace periods from 3 months. I've seen all the way up to 12 months for a grace period. I say 6 months is a good grace period because that is what those federal loan options have. Do these loans have that financial hardship assistance or death and disability discharge? So that's something I would be looking for. And then also some of these loans have promotional discounts. So I've seen recently a 2% principal reduction once the student graduates. I've also seen interest rate reductions for on-time payments. So those are great. And it's just a kind of cherry on top that helps with lessening that balance whenever you graduate. So some cost reduction strategies for private loans. The first is to be proactively improving all of the applicants' credit profiles. So if a student doesn't yet have credit history, it's proactively building that credit history now so they have access to lower cost loans in the future. Selecting a shorter repayment timeline if it does fit into the budget, that's always going to pull that lever and reduce costs over time. Paying any amount of interest while enrolled will reduce the costs, the total cost to borrow. And then I recommend that people rate shop. So applying to 5 or so different lenders within about a 2 to 3 week window of time. When you apply in that short window of time to the credit bureaus, it looks like one hard inquiry. It looks like we're rate shopping, not shopping for multiple loans. So we want to kind of keep that window pretty low. But if you submit 8 applications in that time, it's one hard inquiry because it's one type of loan. So we're rate shopping. And then finally, just understanding that there are opportunities to refinance after graduation. So many people that I work with, they're unaware that this is an option. When I'm talking with graduates right now and they're looking at refinancing options, they're getting rates that are potentially 2 to 4% lower than the rates that they've got during college because they've had that time to build their credit history and they also have employment. They have income coming in, so those rates get lowered. So we have a couple of resources that can help you to find some vetted options. The first is on our student financial aid website. It's called Elm Select. And the Elm Select tool is a loan comparison tool where the lenders that are on there have been vetted by our financial aid office. So they've looked for things like, is there a cosigner release? Do they have grace periods? Are there interest rate reductions? Kind of those more favorable terms. Other sources might be things like your local credit union. Credit unions usually have really favorable rates compared to some of the larger lenders, so that's a good place to start. And then there's a company called Juno that operates kind of like a loan broker. They take a bunch of applications, put them all together, and negotiate rates with larger lenders. And so I am kind of seeing in some of the Reddit threads and chats that some people are finding lower rates by looking at Juno. So that could be an option to keep in your tool belt. So kind of to wrap us up with this first half of the presentation, we're going to talk about what's next. This is just the logistics of what's coming up. The first thing to understand is our next important date is July 23rd. That is when your charges are going to post to the TouchNet billing system. That's not the first bill. So the first bill is actually published in early August, but you can see those charges. So that can help you to get a sense of what your tuition and housing charges might be. In late July, that's when I recommend accepting or declining those federal student loans that are on the student's financial aid portal in Mizzou, and then completing those other loan applications if needed. August 17th, the financial aid office posts all of the financial aid to TouchNet, so it actually pays out to the account, and you'll be able to see that final balance. At that time, if not before, you want to go into Mizzou and double check that you don't have any outstanding action items on your to-do list. So for students, for example, you want to be sure that you've completed things like a master promissory note and entrance counseling for federal loans. September 9th is the enrollment deadline for our payment plan. So we use a 4-installment payment plan. There's a $50 setup fee, but there's no additional interest or charges as long as the installment is paid on time. And that first bill is due September 10th. So I've been talking to a lot of families recently. A lot of people are like, we need to get on this. We need to get on this. But really, you have some time. So, you can take a breather after the webinar, discuss some of those non-loan resources as a family. And then when that bill posts or those charges post July 23rd, we can get on the next steps. So a few student loan frequently asked questions before we move on to planning through graduation. The first question I often get is, how are my loans received? Do I get them? How are they paid to the account? So the amount that you request is generally going to be split between the fall and the spring semester. So if I request $6,000, $3,000 will be applied in the fall, $3,000 will be applied in the spring. The loan gets paid to the university first. It pays any unpaid charges on the bill. If there is excess loan, it can be refunded to the student or family to be used for other qualifying educational expenses. So for example, when you move off campus, you can use that for things like rent or groceries. The second question is, do student loans have simple or compound interest? I see a lot of bad information online about this. So the thing I want you to understand is that almost all student loan interest is simple interest. It operates like a car loan or a mortgage loan. It does not compound regularly like credit card interest does. However, unpaid interest, so if we aren't making payments during college and interest is growing, it capitalizes after the grace period. And what that means is that the unpaid interest gets added to the principal balance, the amount we borrowed, and then new interest grows on that new balance. That only happens in very, very specific instances, and usually it's after we've gone through a period where we haven't been making payments. So just wanted you to know it's not like a monthly compounding situation there. On the third question, when is interest added to my loan? So another question people often ask is my spring loan going to start accruing interest in the fall? And the answer is no. So remember I said those loans are split in half between the fall and the spring semester. So interest only starts accruing once the loan pays out to the account. So fall loans pay August 17th if all the paperwork is done. Spring loans will post in January. So interest won't start accruing on those spring loans until after it pays to the account. And then lastly, when does repayment begin? So for most students, repayment's going to include a grace period. And that grace period means that we're enrolled once we drop below half-time status, which is 6 credit hours, or we graduate. We have the grace period before repayment begins. So for federal loans, that's 6 months. Parent Plus loans require that you request to defer until after the student graduates on the application, but then you get 6 months of a grace period there. And then private student loans, again, they vary from 3 months to 9 months, 12 months. All right, I'm going to catch my breath and take a quick drink, and then we're going to go into part 2. I know our financial aid team is busy answering questions in the chat, so We'll get them caught up too. And we're making good time. So to get us started on part two, we're going to talk about some strategies for planning for the full timeline to graduation. I strongly recommend that parents and students be thinking long term as they're making some of their decisions. The other thing that I want to emphasize is that most often the first year is the most expensive. And I'll tell you a little bit about why that is in just a minute. But when you're looking at the first year, we can generally assume that our costs are going to go down going forward. So when we're looking at this framework for college financial planning, we are all the way over to managing future borrowing. And the very first step to manage future borrowing is to project our costs. Now, this is a rough estimate. It's something that you kind of have to revisit every year. But generally, when you're projecting those costs, we can. I like to estimate that everything's going to go up just a little bit, just so it's always helpful to kind of overestimate costs versus underestimating them. So we can project that our tuition fees might increase by 3 to 4% each year. Now, that's not always going to happen, but again, it's always better to overestimate than underestimate a little bit. Books and supplies usually stays pretty consistent. Off-campus housing and meals I'll discuss in just a minute because people are kind of surprised at how they can save some money in years 2, 3, 4. And then miscellaneous and personal expenses. Students get a better sense of what those are after they've been on campus. So we're going to project those costs, and then we're also going to project our aid. In order to do that, we have to understand if our scholarships are renewable. So any admission scholarship that you have received because of your ACT scores and GPAs, those are renewable, typically for 4 years. But you have to meet some criteria in order for those to be renewable and continue to be paid to you. So we want to understand what that renewability criteria is. For scholarships that are non-renewable, definitely reapply for those because you could be a candidate again and again and again. I know several students who've gotten non-renewable scholarships for multiple years because they continue to submit an application each year. For need-based grants that are FAFSA contingent, those are not guaranteed to stay consistent, but if the family and student income is relatively stable, we can somewhat project that we're going to get a consistent amount. So I like to kind of think of those by understanding what our own income potential looks like. And if our income is going to stay about the same, we can kind of project that we might get the same amount. But it is subject to change. So that's really important to understand. I'm going to talk about residency in just a moment, but there is a point in the corner that non-residents, a lot of you can save some money if you do gain residency. So even if you have a non-resident a scholarship that requires that you be a non-resident, most often for most students, they do have a net benefit of moving to in-state tuition versus maintaining that non-resident scholarship. So next, we're going to talk about strategies to increase our non-loan resources and reduce expenses. Increasing our non-loan resources is always going to be one of the require kind of the most action on our part. So the first thing that we want to be sure that we do is we meet all financial aid priority deadlines, and I'll tell you a little bit more about that in a moment. We're going to treat the scholarship search process like a job. So what that means for students is we're going to commit a time every single month that we're going to be searching for and applying for scholarships. We're going to consider student employment, and I'll share a little bit more with you about that in just a moment, and then also take advantage of the American Opportunity Tax Credit. So this is a tax credit that is available to many taxpayers, and it helps to cover some of our educational expenses. So you can get up to $2,500 back on your tax return if you have $4,000 of educational expenses. So there are some dates that we really want you to be paying attention to. The first is that in the fall, I would recommend that students begin updating scholarship materials for next year. Our scholarship application opens in August for 2027-2028. In October, the FAFSA opens. And both our scholarship applications and our FAFSA applications have a priority deadline in early February. So I always tell students to be sure that they use winter break to finish all of those applications. So get them done by January, and then we are ensure that we don't miss that deadline. In April, that's when we'll get our financial aid offer, and that's when we can assess, go through that process I just walked you through and assess what those expenses might be, look to see what our funding gap's going to be. In May, that's whenever tuition is approved by the Board of Curators for the following year. So each May, you can go onto the cashier's website, see what tuition is going to be, and then really strategically use our summer to potentially earn some income so that we're reducing our costs in the fall. The next thing I always like to share with students is how valuable it can be to continue to apply for scholarships. So to put this into context, if a student earns one $1,000 scholarship, let's say that they spent 52 hours applying for scholarships, 1 hour a week. They've spent 52 hours to receive something that would take them 80 hours of minimum wage work to earn. They're also potentially saving between about $350 and $550 in student loan interest. So definitely worth the time to put into applying for those scholarships. Again, that Mizzou scholarship portal application portal opens in August for next year, for 2027-2028. The next thing that we can do to increase our non-loan resources is really think about student employment. One thing that I'll mention, I often hear from freshmen that, they're not wanting to work during their freshman year, but we actually find that freshmen who work 10, 15 hours per week actually perform better academically because we don't have this suddenly this large amount of free time, and we have to really learn how to have good time management skills and to make use of our time to be studying for school. And we're also earning a little bit. We're building our social network. So generally, that improves student well-being because they're meeting people through those jobs and making some friends. To give you a sense of how much students can earn, in the course of a year, if they work about 10 hours per week, they can earn about $4,400 in both fall and, or not both, between fall and spring, about $2,200 per semester. If they're working 15 hours a week, that increases to about $6,600 for the year. If a student receives federal student aid, if they're eligible, they'll see it in their financial aid offer. One thing to understand about work study is that it does not pay out to the account like all of the other financial aid. It's actually paid directly to the student, and then the student can use it to pay their bill, to pay for their other living expenses. We have a dedicated person in our Career Center who helps students to find and navigate the work study job portal. So you can find that at career.missouri.edu. The Career Center also has a lot of other resources for students to find and prepare for part-time work. And so the link that I have shared here will take you to that part-time jobs information. And then just a quick plug, the Career Center is hosting a part-time job fair for students on September 3rd in Lowry Mall. That's kind of in the middle of campus outside. And we're going to have both on-campus employers and some community employers there to sometimes hire students on the spot. So we've talked about increasing those non-loan resources. Now we're going to talk about decreasing expenses. So I've got kind of four topics. The first two I'm not going to cover in a lot of detail, but I'll briefly explain them first. So the first is that the university has what's called flat rate tuition. And that means the tuition cost is the same for 12 hours, 13, 14, 15, all the way up to 18 credit hours. So a student who is enrolled in 18 credit hours could reasonably reduce their time to graduation by at least a semester, potentially 2 semesters if they're bringing in credit. The second point is considering Missouri residency. And I've got the link here to the registrar's website where you can find more information about residency. But just to give you a sense of what that looks like, the non-resident tuition differential for this year is about $23,000. So if the non-resident related scholarships are less than that amount, chances are it's going to be a net benefit to go ahead and gain residency. You're going to be reducing your cost even if you lose that non-resident scholarship. The last 2 points I'm going to take a little bit more time to talk about. So the first is making intentional housing choices. And just to give you a sense of what this looks like, most of the students that I work with have rents that are between about $550 and $900 a month. As they get towards that $800 or $900 a month, usually utilities and internet are included. And so this is lower than the cost of living in a dorm. So students do have an opportunity to significantly reduce their housing costs as they move off campus. And just to kind of put this in perspective, if we save $100 a month on rent, we're saving $3,600 over those last 3 years and potentially over $1,300 in interest because that's loans that we're not taking out. Another thing I kind of like to joke about with students is that they really ought to learn how to cook a few things and grocery shop on a budget. So I've got some interesting statistic here that college students tend to spend about $400 a month going out to eat, which is about $100 more than the average American. They're not earning $100 more than the average American. So we're spending a lot of our money dining out. But if we actually go and grocery shop instead, most typical Mizzou students are spending anywhere from $250 to $400 a month on groceries and reducing those dining out costs significantly. So building the skill of learning how to cook a few simple things and grocery shop on a budget is a really valuable skill for students to learn early. And then I wouldn't be the Office for Financial Success if I didn't talk a bit about budgeting. It's one of the most important skills that college students can learn so that when they get out into the real world, they've already developed really strong budgeting skills. So some things that we can do with students from day one, even though their housing is covered and their dining is covered through those meal plans and housing, is building some spending awareness, beginning to think about tracking their spending, paying attention to where they're spending kind of habitual dollars on, and focusing on improving financial decision making. So sometimes I'll suggest to students that, parents, give me an allowance. Instead of giving me your debit card, just give me an allowance. I have to learn how to budget that. We can set and meet some savings goals. This helps students to build the habit of living below their means so that we're not overspending and getting to a point where we're living paycheck to paycheck. And then lastly is really focusing on financial security. So building a small cash flow buffer so that we're not relying on debt in the case of a financial emergency. So a common financial emergency for college students is something like I get sick and I can't work for a week. And if I have a small emergency fund, I get to tap into that instead of trying to catch up on my academics while I'm also catching up on work. So to close this out, we're going to talk a bit about strategies to manage borrowing. So there are some key things that are important for every borrower to understand. The first is the importance of building a strong credit profile. So there are a few ways that young students can do that. The first would be to become an authorized user on a parent credit card. And that means that the parent's on-time payment history gets reported on the student's credit report and can help them to build credit without going into debt. The other would be a secured credit card. That's where you make a small deposit at a bank, and then that's the limit. So it's a very small limit, and it's secured by that deposit. And then the third is a no-fee student credit card. Again, small limits. Now, in our office, our motto is credit cards are a method of payment, not a source of funds. So we encourage students, if they are building their credit utilizing credit cards, that they are only making purchases that they were already going to make. Our gas, our groceries, and they're paying it off every week so that we're not getting into debt. It takes about 6 months for a person to build their credit profile. So starting as soon as possible is really important. One other thing that a lot of people don't know is that insurance rates are tied to credit scores. And so if we know young people's interest rate or insurance rates are really, really high. So if they start building a strong credit profile, those interest rates should go down. I'm sorry, those insurance rates should go down and interest rates. The second is to do an annual debt assessment. So this is our know what you'll owe. We're not going to stick our head in the sand. Every single year, we're going to do a debt assessment. We're going to look at the total of all of our loans through studentaid.gov and then our lender. We're going to use loan simulators to kind of simulate future borrowing and simulate those monthly payments. And then we're going to connect that borrowing to career outcomes. So if you hear nothing else from this presentation, I hope that you'll hear this. So, some borrowing guidelines that students can use. The first is that their total debt should be less than their expected annual salary when they graduate. The second is that their monthly payment across all of their loans should be less than about 8 to 10% of their expected monthly income. And a lot of students say, I have no idea what I'm going to do. How am I supposed to know these things? So, what I encourage students to do is start with averages. Start with a median entry level salary for a college graduate. But as we have more information about our major, we can hone that in a little bit. So, some information, even if it's general, is better than no information. And then as far as parent borrowing is concerned, this is just your general debt to income ratio. So, it's generally advisable that all of our debt is less than 36% of our income. That's kind of the high end of a healthy debt to income ratio. So here's an example. If a student is going to earn $45,000 when they graduate, that's kind of one of our guidelines, one of our thresholds. The other guidelines would be if we are looking at 8% of that income, that's about $300. If we're looking at 10%, that's about $375 per month. So we will share a student loan payment quick reference that can kind of help you to look and see what does that look like for my expected salary. And then we also have resources on campus that help students to get this information. So they don't have to go and research it alone. In our MU Career Center, we've got career specialists. We've got things like Handshake and online career tools where they can, with support, look up different professions and kind of see what those salaries look like. And then within each college, like the College of Engineering, the College of Business, College of Agriculture, all of the colleges have their own career services offices. And we also take a survey of all graduates. And the graduates, we ask them what they're earning. So we actually have information for each major about what their recent graduates are earning. And that can be a good place to start. So kind of to conclude that section, really before accepting any loan, it's important to look at what our need is. So we're not over borrowing. We're looking for lower cost alternatives. We are assessing what total borrowing looks like at graduation. And then we're kind of comparing that and aligning that with our expected earnings. But generally, if a student is only borrowing those federal student loans, they're probably going to be borrowing a manageable amount. So most jobs that require a bachelor's degree, the federal student loan limits are within the amount that they would be able to pay with that bachelor's degree. Or there are things like income-driven repayment plans for borrowers that maybe are going into more of a helping profession or social services profession. Now, if we need additional private loans, that's where I would have somebody pause and really take an assessment so that they're making really strategic decisions and only borrowing what we need. And that's where you can work with offices like the Career Resources, academic advisors, offices like mine, the Office for Financial Success, and kind of talk through how can we reduce our expenses? How can we build a budget so that we're reducing our borrowing? So to summarize those last couple of sections, every dollar of scholarship that you earn, every cost that you avoid, and all borrowing that you reduce creates more financial flexibility after graduation. I think we all want that. And then I'm going to leave you with our financial action plan. So our financial action plan for now is we're going to estimate those costs. We're going to look at our available resources to determine our funding gap. We're going to compare those loan options, and then we're going to project our borrowing for year one through graduation. And then every year, we're going to file that FAFSA on time. So just as a reminder, I recommend getting that done in January to meet that February deadline. We're going to be applying for scholarships consistently throughout the year. We're going to track our cumulative borrowing, making really intentional housing decisions. We're going to be building our credit, and we're going to be continuing to explore those career resources. So that is all that I have for you today. Thank you so much for joining us. We had over 500 people in this webinar. If you do have questions, please reach out. We've got contact information on the screen for those 3 financial services offices. We really do want to help. We want to make sure that you understand the decisions that you're making. So please reach out. The financial aid office has appointments available online. They've got their call center open, and they're really, really helpful. So just ask the question when you have it. So I appreciate your time. I wish you all the best, and welcome to Mizzou.
Hi, everybody. We tried to get to as many questions as we could in the Q&A, but there are still several that are unanswered. We are not going to get to all of them as Alex is wrapping up. So please contact our office, either the Office for Financial Success or Mizzou Student Financial Aid, and we will be happy to get your questions answered. But thank you so much for joining us today, and for asking all these wonderful questions. We did our best to get to as many as possible.
Thank you. All right.
Go Tigers!
Go Tigers.